Welcome to Money Matrix, where we break down the world of cryptocurrency to help you build lasting wealth. The signs are all around us. Consumer spending is up, employment is strong, and businesses are investing like never before. Real GDP is growing at an incredible 3.8%. This isn't just growth, this is an economic boom. The machine is running at full capacity, creating wealth at a pace that can transform your entire investment landscape. But here's the secret most investors miss. An economic boom isn't just a time to celebrate. It's a specific market environment that demands a specific strategy. History shows us that economic expansions create big winners and big losers. The investors who understand this and adjust their portfolios accordingly, the ones who see extraordinary returns. Those who stick to the same old strategies, they get left behind. The core principle is simple. During a boom, growth stocks outperform. Why? Because when the whole economy is firing on all cylinders, fast-growing companies go into overdrive. Think about a software company growing at 20% a year. In a boom, that could easily jump to 35 or 40%. We're seeing this play out right now. The S&P 500 Growth Index is up nearly 19% this year, more than double the gains of the value index. But it's not just about buying any growth stock. The real winners are concentrated in specific sectors. Technology firms building the infrastructure for AI are seeing incredible demand. Financial institutions are thriving on increased lending and transaction volumes. Cyclical sectors like industrials and consumer discretionary goods, whose fortunes are tied directly to economic activity, are also capturing the biggest gains. Even healthcare is seeing a boost as people spend more on elective procedures. What about real estate? Here, you need to be selective. Forget traditional office and retail spaces. Structural shifts like remote work and e-commerce have changed that game. The real opportunity is in digital infrastructure. Think data centers powering our AI-driven world. These assets are seeing unprecedented demand. Our EITs, or real estate investment trusts, are a great way to get exposure to these hot sectors without buying property directly. Now, let's talk commodities. The old wisdom says they hedge against inflation, which often comes with a boom, but it's more nuanced. While energy and industrial metals can do well, especially late in the cycle, they are assets to be actively traded, not held forever. Their cycles are notoriously volatile. Gold is a different story. It's your insurance policy against unexpected shocks and geopolitical risk, making a small allocation a smart move even in good times. The biggest challenge during a boom is valuation. When optimism is at its peak, markets often price in perfection, assuming the good times will last forever. They won't. Every boom eventually slows down. This creates a paradox. The best time to invest in the early stages, but by the time a boom is obvious to everyone, valuations are often stretched. So, what's the solution? You need to balance opportunity with risk management. Right now, consumer spending is strong, but forecasts suggest it will slow in 2026. This means the window to capture peak returns is narrowing. Your portfolio should have core holdings in high-quality growth companies with strong balance sheets like Eli Lilly or First Solar. Then, you can add opportunistic positions in more cyclical sectors like financials and industrials for that extra upside, but be ready to manage them actively. Don't forget to look internationally. Economies like Spain and Japan are showing strong fundamentals, offering opportunities to diversify and extend your exposure to growth. The biggest mistake investors make in a boom is taking too much risk. It's complacency. They see their portfolio growing and assume it will never end. The strategy is to be dynamic. Early in the boom, you lean into tech and financials. As it matures, you might rotate toward consumer sectors and commodities, and as signs of a peak emerge, you start trimming your riskier positions and taking profits. It's not about timing the market perfectly, but about recognizing what phase of the cycle you're in and adjusting accordingly. The opportunity is right here, right now. The economy is expanding, and corporate earnings are strong, but the easy gains are likely behind us. The investors who will look back on this period as a massive wealth creation event are the ones who adapt. They will focus on growth, but with discipline, ready to protect their gains when the cycle turns. The question isn't whether to invest in a boom, but how. Thanks for watching. If you found this helpful, don't forget to like this video and subscribe for more insights on how to navigate the markets.